Welcome, dear traders. You are watching a recap of the Asian session on August 17. Stock market sentiment in Japan, Australia and in New Zealand fell sharply today. Asia's major indexes hit multi-month lows early Thursday amid concerns over the U.S. interest rates and China's debt crisis. Meanwhile, they appear to fall differently. For example, while Japan's Nikkei lost only 0.9%, New Zealand's index plummeted by 40 points. In addition to the fact that Asia-Pacific stocks posted losses the day before, and markets are becoming increasingly concerned about signs of a deterioration in China. China's stock markets traded in the red for the fifth consecutive session. Despite the optimistic forecast from the Chinese authorities, important economic indicators do not grow. For example, yesterday's house price index for July was a negative. The average price of new homes in 70 major cities in China dropped to minus 0.1% from the previous zero level. The data raises fears of a potential real estate disaster in China, and this is particularly the case after a major real estate developer, Country Garden Holdings, failed to pay its loan obligations. In addition, Fitch Ratings revised China's sovereign credit rating against the backdrop of snowballing economic problems. The situation in the world's second-largest economy is putting pressure on regional equities and risk assets. This week, larger state-owned banks in China tried to slow down the depreciation of the yuan. They sold US dollars in the domestic and offshore currency markets during trading hours in London and New York. This week has been fruitful for the US currency, and it seems that the currency is far from falling. Yesterday, the minutes from the Fed's July meeting proved this. The US dollar climbed on a Fed's minutes to its 2-month highs, and the reports showed that part of the policymakers still remain hawkish and want to make rate hikes to curb inflation. As a recent macroeconomic data has shown, the US economy is very resilient. Thus, markets can expect at least one more rate hike. On this hawkish forecast, the yield on the 10-year Treasury bond also soared, exceeding 4.25% in August. It's the highest level since November 2007. At the same time, US government bonds continued to support the national currency. In addition, growing investor concerns about China are strengthening and the greenback status as the world's reserve currency. In early Thursday trading, the US dollar index against a basket of 6 currencies posted a peak at 103.40 points. It seems that the greenback is ready to maintain its upward momentum. In Asian trading, the index continues its monthly growth and strengthens within the range of 103.30 and 103.60. The rise in the US dollar index continues to push the Japanese yen deeper in the intervention territory. Since last Friday, when it tested the key level of 145 yen per dollar for the first time in the last 9 months, it has been in a dangerous range. It was at this level that the Japanese authorities were forced to intervene in the foreign exchange market and buy the national currency for the US dollars. Currently, the situation is unfolding according to the same scenario. The Fed is likely to remain hawkish, while the Bank of Japan does not intend to abandon its ultra-loose policy. In addition, the weakness of the Chinese market has significantly reduced Japan's exports. The indicator contracted for the first time in 2 years, coming in at minus 0.3%. Most likely, the Bank of Japan's market intervention to protect the yen is moderately strengthening the national currency. The dollar-yen pair settled in a narrow range of 146 and 146.60 in the early Thursday trading. The yen closed the Asian session in the red of 146.10. However, global risk aversion, rising Treasury yields, and the Fed's hawkish outlook continued to put pressure on the yen. Mixed Japanese trade balance and upbeat machinery orders data are providing additional support for the Bank of Japan's ultra-loose monetary policy. The Australian dollar began today's trading against a backdrop of negative factors. Negative news from China added to the previous day's fall on Wall Street and risk aversion. Data on the Australian economy also showed that Australia's unemployment rate rose to a 3-month high of 3.7% in July, and the labor market decline may become another sign of an impending recession. Meanwhile, the antipodian currencies, often used as a liquid proxies for yuan, and have also suffered in recent recessions due to the deteriorating outlook for the Chinese economy. As a result, the Aussie saw a sharp drop today. The Australian currency tested the key support of 0.6370 in the Asian session. The Aussie then strengthened moderately, but continues to trade within the range of 0.6365 and 0.6429. The Aussie dollar pair closed the session settling near 0.6400. The New Zealand dollar also had no reasons to grow today. Yesterday, the Reserve Bank of New Zealand left the key rate unchanged, strengthening the bearish outlook for the Kiwi. The New Zealand dollar continues to decline for the 8th session in a row. At the same time, the currency remains at its lows for more than 9 months. At the beginning of Thursday, the Kiwi dollar pair saw a dip in the range of 0.5903 and 0.5946 and almost reached the support level of 0.59. However, the Kiwi closed the Asian session near 0.5930, trading in the bearish trend after a significant bounce on the US dollar consolidation. And that's all for now. Leave your comments down below and don't miss our next video review. Remember that staying up to date is a key to success in your trading. See you online soon!